Awesome. Hey, good afternoon, everyone. Great to have everyone here, and it's a beautiful Tuesday afternoon in Toronto. We finally have some nice weather, and we also have a really interesting change coming here in the tax system in Canada, and a lot of questions getting asked. Want to introduce myself. I'm Shayan Rashid, the managing partner of SRJ Chartered Accountants. Uh, uh, and also today with me, the CPA Masters of Tax Specialist. So we're going to take you guys through the changes in the capital gains rate that has been proposed and will be effective in a few weeks, or sorry, less than 2 weeks. And then discuss the implications of the changes and how that's going to impact uh, individuals and businesses across the board. So without further ado, let's. Okay, so the capital gains changes are coming into effect under 10 days, and it was one of the major items proposed in the 2024 federal budget. And it's not necessarily an increase in the tax rate, but it's an increase in the amount of capital gains which gets added to our taxable income for the year. And the rate will affect both individuals and corporations. So we have to keep that in mind. There are various implications of the changes, and it impacts everyone across the board. Also, there is going to be an impact to trusts as well, who earn capital gains within their portfolio income. So Arif, I'll let you dive into some of the specific items when it comes to the rate changes, and then any insights you have on these items as well.
Awesome. Thanks, Shayan. Let's dive in here. So I think the first thing which Shayan's already alluded to is that there's no change in tax rates. So when we're talking about the capital gains inclusion rate, just to step back here for a moment, like right now the way the rules work is that if you have a capital gain, you only pay tax on half of it. So if I buy a share of Apple and it appreciates $1,000 and I sell it, I only pay tax on half the gain, so the $500. The other half is non-taxable. And the half the gain that I pay tax on, that tax rate just depends on whether I'm an individual, trust, or corporation, and then the various tax rates that are applicable to each of those types of entities. So again, there's no changes to the actual tax rate, but to the inclusion rate. So the proposed change is that we are going to go from a 50% inclusion rate to a 66.67 or 2/3 inclusion rate. And again, I guess just for additional context, like Canada hasn't always had a 50% inclusion rate. We've had 2/3 before, and now again it seems like we're going back to 2/3. However, like a lot of tax changes recently, it's not as simple as just a straightforward 2/3 inclusion rate. So there is a bit of a difference between how this inclusion rate will apply for individuals versus corporations and trusts. So for individuals, going forward, any gains on an annual basis that are below 250K will still get that 50% inclusion rate. However, any gains in excess of 250K will then be subject to the new 2/3 inclusion rate. So in other words, if I have $1,000 gain, 667 of that is taxable, 333 is going to be non-taxable. So as an individual, you have this sort of like limit on an annual basis that you still get the old inclusion rate for. However, for trusts and corporations, that will not be the case. They're just going to have the new 2/3 inclusion rate, and it's simply that basically. So there's no like annual limit up to which they get the old inclusion rate. They're just going to have the 2/3 inclusion rate. So this, it raises a few points. I think if you look at it from a excuse me, individual's perspective, if you have this limit of 250K annually, it provides some thinking around, okay, well, if I'm going to be selling off, maybe a part of my portfolio, how do I time it properly so that I can take advantage of this limit? In certain cases, you may not, again, like for example, like let's say you're selling real estate, right? You can't really, for the most part, like you can't really split up a single piece of real estate and sell it separately. But if you could, again, a potential planning consideration to see how you can maybe average out your gains as opposed to have them, in 1 year to effectively take advantage of this 250K sale threshold. So that's a planning consideration specifically for individuals. And I think, sort of in the same vein, even when we're looking at trusts, again, like we want to take a look at, okay, well, are we allocating the right income so that we're not taxing capital gains inside a trust? So those are some, I'll say some basic planning considerations that individuals can take a look at in light of these changes. Um, and again, this is sort of going forward. Obviously, taking a step back, we still have about a week left before these changes kick in. The effective date is June 25th, 2024. So the other thing we do want to consider is are there things that we want to sell before this date to take advantage of the current inclusion rate? And there's no like clear yes or no answer. It really does mean that you do have to sort of look at what's in your portfolio, what's your goal in terms of long term. Are you looking to sell? Do you need the money? So these are all considerations that have to be sort of taken into account if you are thinking about any sales before the change in date. Shayan, anything else you want to add to that point?
Yeah, I think all good points we're getting over the last few weeks have been around sort of should I force a sale? What is my cost benefit on a specific asset? And I think that when you look at sort of how the inclusion rate is calculated, there is essentially an additional. Let's say if you're at the highest tax rate, it could be, let's say, 8 to 10% additional tax on any gains over 250 for individuals or corporations. And that so if you can earn a higher rate of return over 1 or 2 years by keeping your nest egg or that asset intact, then it's not necessarily advisable to try to preempt the increase and sell any asset. So then there's various planning around that, but it really comes down to what we expect annually in a rate of return. And do we need to incur this additional tax voluntarily for sort of basic situations? Where we're seeing it a lot more is for groups of individuals or families where they've been sitting on an asset for a long time. Let's call it multifamily residential real estate properties. It's been passed down to the second generation. We saw some flurry of activities in that space over the last couple of months where people wanted to take advantage of the gains at the lower rate, and they were looking for quick deals to close before the June 25th deadline. So that's what we've seen. That's where people were taking advantage of it specifically, and there was a little bit of extra activity that we weren't expecting. And other places you may expect is if you have a large asset with very low cost base, let's call it crypto. People are trying to take advantage of those spaces, but generally we're not. There hasn't been too many people rushing to sell off assets to take advantage of this because it does. It relates more to either people who are going to sell their business and they have a big gain, or people who have a portfolio investment, well, whether it's real estate or with huge gains, and they want to and they know they're going to sell that asset eventually in the next 6 months or so, so they may sell it sooner rather than later to realize that gain. So another area that we've got a lot of questions about, and you'll see a lot of this in the media, it was around vacation properties being passed down from generation to generation, and if there would be a taxable implication on those properties, since they are not necessarily principal residences of the individual passing them down. They want to pass it down to, let's say, their kids or their grandkids, and they have a very low cost basis, so there's a significant gain on those properties. We had a interview at CBC, and in that they were specifically focusing one of their segments on this specific issue, in discussing how the vacation properties could be a potential issue for a lot of individuals who've had these properties in their families for generation. Or if you want, from, let's say, the grandparents to the kids or the grandkids, and how that could result in tax. Sorry, I'm not sure if I cut off there. Let's talk about the vacation properties and passing down the properties from one generation to the other, and how that could result in.
Yeah, sorry. I think I got you there. Yeah, so I mean, generally speaking, like, when we have a vacation property or perhaps a second property, in a lot of cases, like, that property might get passed down, like Shayan said, from grandparents or parents or whatever it is. And in some cases where it's possible, we can try and use the principal residence exemption to shelter some of that gain. But eventually, like, you sort of get to a point where that might not be a viable option anymore. So, you might have a property that in the past you were able to shelter the gain as well as residence exemption. However, given how real estate has appreciated in the last decade or so, and probably a bit longer than that, to be honest, you may be sitting on a huge gain, and you no longer have the opportunity to really shelter it with a principal residence exemption because it may not meet the conditions of that exemption. So what you basically end up with is a property that has a low cost base, but has a massive accrued gain. And so basically that ends up meaning that if you don't take advantage of the capital gain inclusion rate right now, it means that you will eventually have to pay tax with the higher inclusion rate, which is a 2/3 inclusion rate, which effectively increases the overall tax rate. So that's sort of like a pretty basic scenario where you can end up with a lot more tax without realizing that liability exists. Alrighty, I think we'll move on. So we'll move on to corporations now. So I've already touched on this a little bit earlier, but just to touch on it a bit more again. Again, we don't have the 250K annual limit for corporations. It's only available for individuals. So corporations are going to see an increased rate from the first capital gain starting June 25th, 2024. So let's consider a very simple example. So right now, in Ontario, for instance, and just to just keep things very simple, I won't really talk about refundable tax, but to keep things very simple, in Ontario, the corporate tax rate on capital gains right now is roughly about 25% before any refundable tax, right? Which is half of the actual tax rate, which is 50%. So that's the current tax rate on capital gains in Ontario. After refundable tax, it goes down to about 10%, right? Now, again, if we consider the new inclusion rate of 67% or two-thirds, then that rate from 25% goes to about 37%, right, roughly. So we've increased the overall effective tax rate on capital gains in corporation to 37. And again, what do you call it? The refundable portion would then, after the refundable portion, you'd be left with about 15%, got my numbers right there, of corporate tax rates. So overall, the corporation isn't seeing any benefit on that first 250. So they've got more capital gains in the corporation. Sorry, more capital gains inclusion rate in the corporation. So from a corporate perspective, there's probably even a greater need to have some discussions around any portfolios or any investments that are being held within the corporation. Because again, going forward, you don't have that opportunity to use any of that 250K annual limit. So that this could mean things like you're looking at your portfolios to determine, is there something that should be sold, something that should be held. And again, like there isn't a like Sean's already talked about this a few minutes ago as well. Like the answer isn't like yes, you have to sell. It's more like, okay, if I hold on to this, what's going to be my return? What's going to be the tax on that? Does it make sense to hold? Does it make sense to sell? So these are all questions that you have to ask for your investments to determine, is it worth selling, or should it just be held on to until a future date? So for some of our clients, we'll even do a bit of a detailed cost benefit break even analysis to figure out at what point does it make sense to sell now versus hold on to it and sell later. So again, these are things to consider as we're looking at this upcoming change. So some takeaways from this. I would say that the key takeaways from this is that we're going to have some significant changes in the Canadian taxes going forward. The presumption is that these changes will go through. To be clear, like they haven't received royal assent yet from a legal perspective, but we do expect these changes to go through, and that means that again, like it changes what's going to happen right now, but even going forward, it changes how people may invest their money. So whether we're investing personally or we're investing within a corporation, we have to reevaluate what vehicles we use to hold those investments. So does it still make sense to hold investment portfolios? Are there other tools out there that can be used to try and effectively mitigate this tax change? So I think those are some of the key points. Overall, there probably do need to be planning discussions with your advisors, reviewing your portfolios, and making sure that you're getting ahead of what needs to be done, as opposed to getting later in the year and then not being able to do anything. So that's everything. We'll open the floor for any questions that you guys might have.
Thanks, Arif. One of the things that it's important to consider is for there were additional implications for small business owners, which are which are positive as well. So for anyone looking to sell their business, there was an increase of the lifetime capital gains exemption for Canadian controlled private corporations, which were great. And that's gone up from just under $1 million to $1.25 million. Now an additional $200K for certain founders, which is also great. So there's certain planning that can be done for owners of businesses to multiply the capital gains exemption, and we've been doing quite a bit of that corporate reorganization work over the last year. And what that allows to do is basically take that 1.25 million exemption for one person, one shareholder, and potentially have additional shareholders come in from the family, let's say a spouse or children, and multiply that capital gains lifetime exemption. So you get 2 or 3 or 4. So let's say there's spouses and 2 children. That would essentially mean you have 4 capital gains exemptions, which would add up to 1.25 multiplied by 4, $5 million of exemption on the sale of the shares of that corporation. So a lot of really interesting opportunities right now. And there was one session I was doing about, can I use the lifetime capital gains exemption on passive assets, let's say a rental property in a holdco. So that's not necessarily what the lifetime capital gains exemption is available for. It's more for active businesses, operating companies who have essentially gained the cost basis of their shares. Yeah, so thanks for the question. And is the lifetime capital gains exemption is only if you're selling a business, right? Not for a capital property balance sheet. That's correct. The only time there's an exemption to that is if you have a building that is used in the active business, where you could also apply your lifetime capital gains exemption to it. Arif, I'm not sure if you want to get into if you are able to get to some of the technical details there, uh, when you can sell the building and use the user exemption.
Can you sell a corporation with a building and use the exemption? Is that the question?
Yeah, if the building is used in the active business, yeah.
Yeah. So I think that does exist. You do have to demonstrate that the building was used by an associated business, an active business. And as long as you're able to demonstrate that, you can potentially meet the tests that are required to claim the lifetime capital gains exemption.
Okay, great. Yeah. So I think I don't see any other questions coming in right now. To other insights here, other market changes that we've been seeing in relation to people either coming into Canada or leaving Canada is quite a bit looking at sort of the tax gains on leaving Canada and the deemed disposition of any investment properties or any portfolios. So that will also be impacted by this decision. If you're, let's say, planning to leave later on in the year, you may want to expedite what your date of departure is going to be, as it could impact significantly the tax you pay on departure. And then also people coming into Canada may want to get documentation to support their cost basis on any assets when they enter the country. That would be the cost basis going forward, and what they would pay gains on if they do sell those assets later on. So various implications, not just short term. There's also long term things to think about. Okay. Okay, sounds good. If anyone does want to discuss or you have questions later on, feel free to reach out to us. You can shoot us a note at info@srjca.com, or you can just contact the firm and connect with us directly. Arif and I are happy to help out and discuss any issues that you have. And yeah, if there are any sort of planning considerations, we're looking at options that are available to take cash out from corporations. We're trying to optimize these days for how individuals who have companies can take tax out of the corporations at more reasonable tax rates and optimizing for the withdrawal of cash. So happy to discuss the planning considerations around that and different options to minimize gains on any investment income. So reach out to us. We're available, and this is our first webinar of the year, and we're hoping to do quite a few throughout the year. Just quick webinars to give some updates and some technical summaries of what's going on with the CRA. All right, thanks everyone. Thanks Arif, and thanks Hiba for help organizing. So take care, everyone.